Hi, I'm John Stewart, Chief Investment Officer of Farmers Trust Company. This is The Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.
Hi, I'm John Stewart. Welcome to The Investor's Edge. First up, the week in review. Can anything stop this train? So stock's torrid run higher in 2024 has continued at such a blistering pace, it makes one wonder whether stocks are still capable of actually falling in value. Of course, such complacency is in and of itself somewhat of a warning sign. And this complacency is corroborated by the volatility index, which reached its lowest level since July this past week. So are investors throwing caution to the wind and ignoring the potential risks that are still inherent in this market? Well, at 22 times next year's earnings forecast for the S&P 500, it's certainly hard to argue that stocks are cheap at these levels. Also, earnings estimates for the next few quarters have actually been falling for the past few months. Now, market momentum is a powerful force, and there are no rules that dictate what the market can and cannot do. So enjoy the ride, but be sure to stick to a well-thought-out asset allocation plan. If this move higher has your equity allocation at levels that significantly exceed your target weighting, a rebalancing of your portfolio may be in order. For this week's featured insight, mind the flows. Well, speaking of market momentum, it's difficult to stress just how much passive investment flows have come to dominate the equity market. Now, what are passive flows, you ask? Well, over the last 20 or so years, investors have increasingly come to use passive indexes like the S&P 500 in their portfolios, as opposed to actively managed mutual funds or individual stocks. And given this strong performance of the S&P 500 over basically every other asset class during the last 15 years, this strategy has made a lot of sense. So as long as investors keep pouring cash into the market, or in other words, as long as America remains fully employed, this process is essentially self-perpetuating. However, a deterioration in the employment picture could change that dynamic. Looking ahead, will inflation readings spoil the party? We've been experiencing disinflation for roughly the last 18 months. Which means the rate of inflation is falling. In other words, prices are rising, just at a slower pace than before. It's now fairly commonly accepted wisdom on Wall Street that inflation is yesterday's problem. Therefore, the Fed's been able to start lowering interest rates, and that trend is expected to continue into 2025. But what if inflation remains stickier than people think it will? We'll get some data on that next week with the monthly Consumer Price Index reading, or CPI, as well as the Producer Price Index, or PPI. Now, if those numbers surprise to the upside, it could throw a wrench in the market's expectations for further rate cuts. And that could throw a wrench in the market rally. Now, let's hope it doesn't, but when no one is expecting a negative surprise, that's when the market becomes more vulnerable to getting one. Once again, I'm John Stewart. Thank you for watching The Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.